There is a lot of speculation about whether or not we are headed for a housing crash in 2021. And that's why I wanted to take a look at some of the key areas that led to the housing crash of 2008 to see if we're in store for something big here in 2021 as well. That we might be in a housing bubble, prices have to decrease, that housing affordability would be very low. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button and together we'll make it happen. There are 6 areas that I took a look at, and I want to share them with you. So here we go. First up are housing prices. Last year, we saw a significant increase in home prices, up 9.2%, which means that the average homeowner has seen an increase of about $24,000 in home equity over the previous year. And I believe that that is the number one thing that is leading many to believe that we might be in a housing bubble similar to what we saw in 2008. But let's take a look and see what happened for the few years leading up to that housing crash. In 2002, we saw an 8.5% appreciation rate. In 2003, 8.7%. 2004, 12.5%, and 2005, 11.4%. Those are some pretty significant housing price appreciation rates that we saw prior to the crash. Last year's housing appreciation was much higher than we've seen over the last few years. In fact, in 2017, it was just 6.4%, 2018, 4.8%, and 2019, 4.7%. So what's normal? Well, normal is sitting generally right around 3.8%. So while we are seeing a little bit higher appreciation over the last few years in comparison to what's normal, we are seeing nothing like it was leading up to the years prior to the crash we saw in 2006, 7, and 8. But there's more to the story that we have to take a look at to see if we are going to be headed for a real estate market crash here in 2021. And that is mortgage financing. Back in 2006, 7, and 8, you could get just about anybody qualified for a mortgage. In fact, you didn't even have to prove any income in certain situations. We're far from those days, which means that credit standards have tightened significantly. The Urban Institute releases what they call their Housing Credit Availability Index. Basically, what it does is it monitors how much risk lenders are willing to take. A lower index means that lenders are willing to take less risk, while a higher index means that they're willing to take more risk. So if we look historically, we can see where things were prior to the crash and where they are now. There was a significant willingness on the side of the lender to take more risk, and that makes sense. Even if a borrower defaulted, the lender had very little risk because they could turn around and sell that home, likely for a profit. Well, that all changed when the market crashed. Lenders certainly did not want to take that risk any longer because housing prices started to decline. And since then, the standard by which lenders are willing to lend money has remained fairly consistent at a low tolerance for risk. In fact, significantly lower than the standards we saw prior to the crash. We are less than half of what we saw prior to 2001 to 2003, which means that even if we doubled the amount of risk that lenders were willing to take, we would still be below the standards of 2001 through 2003. Can you do me a favor? If you're enjoying the video and the content that I'm sharing with you, if you can give me a quick thumbs up, I'd appreciate it. It helps me reach more people just like you. What else caused the crash, and are we looking at the same situation today? Another big factor that led to the crash before was an overabundance of homes available on the market. Well, that is far from where we are at today. In fact, we are seeing record low inventory levels. In 2020, we had just 2.1 months of supply. We're even lower now. And a normal market is 6 months worth of inventory. So you can see we have very, very few homes on the market in comparison to the demand that buyers have right now. Well, between 2004 and 2007, leading up to the housing bubble, we saw housing inventory increase from 3.9 months up to 9.6 months. There were so many excess homes available on the market in comparison to what we're seeing today. Well, with simple supply and demand economics, if we have an overabundance of homes or an excess supply and the demand stays the same, what happens? Well, prices have to decrease. And that's exactly what led to the housing crash in 2008. But new construction made it even worse. Due to the housing appreciation rates, speculation was at an all-time high. People were willing to buy homes, anticipating that within just a few months they can make thousands, if not tens of thousands, or even hundreds of thousands of dollars by selling the home a few months later. Builders were doing everything they could to keep up with the demand, to build and build and build. And for the 4 years leading to the housing crash, we saw a record number of new construction homes being built. Well, over the past 13 years, we are below the 50-year average of new construction homes. So not only do we have a low inventory, but we have less homes being built than we have historically, which makes the inventory issue an even bigger problem that we're facing right now. And you would think with the housing inventory levels as low as they are, that housing affordability would be very low. But that's not what we're seeing. When it comes to housing affordability, there are 3 factors. First, home prices. Second, mortgage rates. And third, incomes. Well, in 2006, we hit a high of 25.4%, which means that housing was very expensive and less affordable. To put that in perspective, between 1985 and 2000, the average was 21.2%. So you might be wondering, where are we at today? Well, today we're at 14.9%, which means that housing affordability today is much better than it was back in 2006, leading up to the housing bubble. And there's one other big factor, and that's home equity. Because of the leniency of mortgage rules and guidelines, people could tap into their equity much more easily than they can today. Not only were we able to have very lenient rules in terms of qualifying on income and assets, but we also had very high loan-to-value limits, sometimes exceeding the value of the home, going up to 103 or 105% of the home value that you could borrow. That led to people cashing out the equity in their home. Between 2005 and 2007, $824 billion worth of home equity was accessed. Comparing that to the last 3 years between 2018 and 2020, just $348 billion were accessed despite record low interest rates and huge refinance activity to take advantage of those interest rates. The reason for that is because you simply aren't able to do what you did back in 2007 and 2008. So right now we have record low inventory. We have great housing affordability. We've got good equity positions. And there is still plenty of room for home builders to build without negatively impacting the market and having an excess supply of homes. Based on all this information, I just don't see a housing crash in our future, at least in the near future. Now that may change as more inventory becomes available, or as interest rates increase, or maybe home prices get to a point that aren't sustainable. But as of right now, I think we're in a good spot, and I do not believe that a housing crash is going to occur in 2021.